Okay, I think we can get started. Looks like we've got a critical mass of folks that have already logged in. Thank you for coming on time. I want to really welcome you to the Next Wave Global Corporate Venturing webinar series. And the session will explore how follow-on financings are handled from a CVC perspective. I'm Mark Klopp, and I'm a course leader with the GCV Institute, as well as a CVC advisor and an angel investor. I started my career in the CVC world as the head of Eastman Chemical's corporate venture capital group. So for some background, we've seen that high potential startups and syndicate partners have clear expectations of both the strategic capabilities and the investment professionalism of CVCs. A willingness to participate in follow-on rounds is seen as one indicator that a CVC really understands the rules of the VC game. And the GCV Keystone benchmarking research, which we'll share in more detail in a couple of slides, shows that more than half of CVCs now allocate at least 20% of their capital as follow-on reserves. But a willingness to follow on doesn't mean ignoring sound investment management practices or creatively contributing in other ways, and we'll explore that in the panel as well. There are some understood venture ecosystem expectations that come with corporate venture capital. And that includes supporting financing of the portfolio companies, having adequate reserves available and allocated, reliable and consistent investment behavior, also transparent intentions to participate with no surprises or last-minute changes. And finally, fast decisions and streamlined mechanics with the governance process. So today we have a very savvy and experienced panel, and that includes David Hayes, who's now a VC with Decarbonization Partners after an extensive career as a CVC while spending more than a decade developing and leading BP Ventures investment practice. Sandy Knox is our legal person who's a partner with Sidley Austin, leading this firm's CVC practice. And our European CVC is Crispin Leek, representing ENBW New Ventures, and he brings experience with multiple CVCs and operating models. So today, as far as an agenda, we're going to review some Keystone data, as I indicated before. Panelists will introduce themselves. I'll start with some Q&A and moderate some discussion, and then we're going to turn it over to participant questions, and then finally have a wrap-up. So before getting started with the panel, I'd like to spend a few minutes framing our conversation with some data from GCV's Keystone CVC benchmarking platform, which happens to be the most comprehensive source of CVC operational and performance data. Over the past decade, we've seen the scale and influence of CVCs in the startup funding lifecycle increasing. So more than three-quarters, or 77% of our most recent survey respondents are active investors, with 42% of those looking to make 4 to 6 investments per year, 11% are looking to make 7 to 9 investments, and 13% plan to target more than 10 new startups annually. The sweet spot as far as stage for the overwhelming majority is the early stage in Series A and B. However, a growing number of corporates, 57% this year compared with 48% last year, will also invest in seed stage or pre-revenue funding rounds. All of those certainly will likely be faced with follow-on funding decisions and reserves required. So with the rising professionalism of the community, more CVCs are willing to lead rounds. Nearly half of the respondents say they are equally comfortable leading or following, while 6% actively seek to lead, and they sometimes take voting board seats or observer roles, and they have associated fundraising accountability. However, about half still prefer to follow an institutional VC lead. In most of these cases, the investment committees own the decisions on initial investment approval, and follow-ons. However, 22% of the CVC teams are now empowered to manage investments with lifetime investment approval for startups that continue to perform and hit their criteria. Around 1 in 5, or 18%, typically these are mature programs, have an independent investment team approval rights for transactions below a certain size. That could be 5 million, 10 million, or even something like 1 million, depending on the company. And financial portfolio management practices are becoming more sophisticated, with more than half of the respondents using portfolio construction models for fund planning and management. More than half of these reserve at least 21% or more for follow-on funding, though 1/5 still do not allocate capital for follow-ons. The percentage of CVCs not reserving for follow-ons drops to single digits with CVCs with more independent operating models, and 1/3 reserving more than 30% of capital, and 22% set aside more than 40% of capital for follow-ons. So with that as context, let's go ahead and move to the panel and get their perspectives on the art of the follow-on for CVCs. So I'd like to first each ask our panelists to give a short introduction to themselves and their firm, and then I'll move into some questions while working in questions that our audience sends in through the Q&A. So make sure when you do have questions, submit those through the Q&A. David, why don't you start, and then we'll follow that by Sandy and Crispin on the introductions.
Awesome. Thanks, Mark. And hi, everybody watching at home or in the office, depending on if you're in a hybrid work situation or not. Great to be here. As Mark said, I'm David Hayes. I'm one of the actual managing directors, not partners, at Decarbonisation Partners, and also one of the investment committee members there. Who are we? We're a financial fund. In fact, we're the first of what is hoped to be 3 funds. So BlackRock and Temasek came together in a joint venture, 50-50 JV, to launch a series of funds to try and convene capital around the energy transition. We closed our first fund, a 1.40 billion fund, and it's worth the 0. We're not actually rounding it up to 1.4. It's 1.40 on the nose. We closed the fund about 2 weeks ago. We started with $300 million of seed capital from BlackRock and Temasek, and have raised more than $1 billion of external capital over the last 18 months or so. So the fund was formally launched in February of 2002, but it's taken us until a couple of weeks ago to actually close out. We are a late venture, early growth fund. We say typically Series C, Series D. But what we really mean is technology is past the point of technical risk. We won't scale physics, chemistry, or biology. We won't build pilots or demos. We're really there to build first-of-kind facilities at the true sort of industrial and commercial scale. Beyond technology risk, we also look for desperate customers. Megan Sharp, who leads our group, is fond of that phrase. It's really revenue today, and if not revenue today, it's committed revenue for tomorrow. We'll write $50 to $100 million checks into these opportunities, looking for significant minority and board representation. We really want to be hands-on with portfolio management and helping grow these opportunities across the team. Deep bench strength and experience in venture capital. And it's a global activity. There's 25 of us globally, 17 on the investment side, and really wherever we can see desperate customers, proven technology, and a low carbon outcome, we can deploy capital. And as Mark mentioned, I was, a financial VC here in this forum. Why? I was with BP for about 13 years on the corporate VC side. I was not leading the group though. That was Megan Sharp, who leads a group at Decarb, but I was a member of the leadership team there amongst colleagues. But good to be here. Yep,
Sandy, please go ahead.
Great, thanks for that. Great to be here. I am a partner with Sidley Austin in our Palo Alto office, where I was a founding member of the Palo Alto office in 2010, also a founding member of the emerging companies and venture capital practice for Sidley. Sidley is a 158-year-old law firm, originally founded in Chicago, and now we are dual headquartered in Chicago and New York. We have 2,300 lawyers in 21 offices around the globe. My practice is primarily focused on investor side, non-traditional participants in the venture-backed ecosystem. So primarily that means corporates. It also means sovereign wealth funds, large growth equity investors, and so forth, investing in, generally later stages, with corporates making up the bulk of the practice. I represent corporate venture capital units ranging from early, newly founded corporate venture capital units that are investing from the balance sheet, all the way up to much more mature corporate venture capital operations that have a traditional GP-LP structure. The clients that I work with invest in all industries and sectors that are fundamental drivers of the global economy. So that includes transportation, energy, agriculture, food, healthcare, life sciences, banking, insurance, and I'm very pleased to be here, representing the voice of, the anonymized voices of the clients who I work with. Mark asked me to also mention that I spent the first 10 years of my career, which started in 1999 in the middle of the internet boom in Palo Alto, working for Wilson Sonsini, where I represented any number of early stage startup companies. Probably 80% of my practice consisted of formations, venture capital financings, IPOs when that was a common thing, mergers and acquisitions, and so forth. So I've seen it all over the past 25 years, and I find that I really enjoy working in the CVC ecosystem because corporates can do really consequential things, not only by supporting disruptors across these sectors, but by also writing big checks, being referenceable customers, co-development partners, and it's just a really exciting place to practice. So I'll hand it over to Crispin.
Thank you, Sandy. Hi, honored to be with you today. Thank you very much for the invitation also from my side. I am Crispin Like, Managing Director of EnBW New Ventures. I am 51 years old. Maybe I give it a little European touch. So I'm 51 years old. I'm married. I have 4 kids. And I'm living and working in good old Germany. Yeah, I'm a chemical engineer by training, and actually added later on an EMBA from GSB Chicago. And yeah, I'm now 27 years in business, always commercial roles and operational roles. I entered the renewable energy and energy transition space already 22 years ago. And this has been a huge topic of my whole business endeavor since then. I started with CVC more than 16 years ago, and actually it really feels a little bit like a dinosaur. So I'm currently running my second CVC program. Both programs were actually established for large German utilities, and both of them were centered around sustainability. So the first one actually lived through all setups you can actually think of for a CVC. So it started as an internal department, investing from the balance sheet, like many CVCs, I would add, unfortunately do. And it ended actually being a spin-off, fully fledged GP-LP structure with a corporate investor and an institutional investor. And then a little bit more than 8 years ago, I jumped actually into the second CVC endeavor together with EnBW. And what I tried to do is actually to take all the learnings from the first endeavor and the developments to bring this to EnBW New Ventures. Maybe, as probably many of you don't know EnBW, just a couple of data points. It's one of the largest German utilities. There's over 28,000 employees, 44 billion revenue, 6 billion EBITDA. Actually, EnBW is active the whole value chain of the utility, which means from generation over trading to sales, and even managing grids. And especially in the last years, also running the largest German fast charging network for electric cars. So that is a new activity. EnBW is heavily investing in renewable power generation, onshore, offshore wind, photovoltaics, is investing into the grid and into electric mobility. In the next years, it will be around 40 billion of asset investments. So they are doing the heavy lifting. Back to EnBW New Ventures, we are a single LP structure, 100 million evergreen. We focus on late seed Series A as a sweet spot. We write initially typically 2 million tickets, so a little bit smaller than what we just heard from David, up to 10 million over a couple of rounds. We invested into 20 startups. And what is maybe sort of noteworthy is that we have already exited 5 successfully. We have done in these 8 years over 60 transactions. So when you see 20 startups and 60 transactions, we have done quite a lot of follow-ons. And we do lead and co. We typically go first in the direction of 10% participation, maximum 20% on the cap table. And we focus on startups headquartered in Europe. As we are an evergreen, we are always in the market on the buy and on the sell side, which is quite interesting, as you can imagine. And the sector focus is, not surprisingly, sustainable and digital infrastructure, but not sort of the asset side, but really sort of the startups that enable and make the infrastructure easier to build, easier to operate, to maintain, more digital and more sustainable. So that's basically our key topic. Well, thank you. Back to Mark.
Thanks, Crispin and David and Sandy. Really appreciate the introductions. Great background for our discussion. And I'm going to go right back to you, Crispin, on the first question and ask David to chime in as well. Do you do follow-ons? And is this reflected in your model in some way? And then the third part of that question is, how much do you typically reserve for follow-ons, or is there a typical situation?
Yes, we definitely do follow-ons, as I just indicated. When we enter late seed Series A, we typically continue and follow on Series B, Series C. Then we start to look in the direction of an exit. And actually, when we enter into a new investment, we look at the start of the maturity. So we have sort of a certain portfolio allocation logic where we say, okay, a certain multiple of the initial ticket is reserved for follow-on rounds, but we make it specific on each case. So we also ask ourselves, okay, how strong is the consortium? How capital intensive is the business model? So what is maybe needed until the break even can be reached? And then we sort of connect these dots together and reserve something for follow-on rounds if the startup develops successfully. And we only, of course, do it then.
Yeah. And what range would you typically see going from, let's say, your earliest investment to your later stage investment? Are you talking about 10 to 40%? Are we talking about 20 to 50? What kind of?
No, I think we're working on a different metric. If you would look at on the overall fund, I would guesstimate that we are sort of 30-40%. But on the individual case, like if we do the first ticket, we sort of scale into also the participation. Yeah. So if we invest, for example, 2 million, we reserve a multiple of these 2 million for follow-ons. So not just 10-20% or so, but much more.
Yeah. So you may allocate a certain total dollar amount for each portfolio company, and the reserves would be indicated on the stages and the requirements, the capital intensity of the company.
Exactly. And what is maybe worth noting, just as a last point, is that we actually revisit these capital allocations at each round, of course, but also every year. Even if there's no round, once per year, we just check out, okay, is this allocation still adequate for this startup?
Okay, great. David, how does it contrast with decarbonization?
Yeah, I mean, I guess we're in our first fund, and we've made 7 investments so far. Some of those are actually coming back to market now. They were made in 2022, and whenever we underwrite, we look to try and make sure we've got 2 years of capital. So it kind of makes sense that we're having those follow-on conversations now live. In terms of portfolio construction, I think we've reserved essentially 1/3 of the overall fund capital for follow-on. That's more just from starting with a blank sheet of paper and thinking about what is the average ticket size going to need to be? We skew hardware, if I'm honest, or hard tech, high capital companies like
Yeah.
Monolith, Group 14, Ascend Elements. We're building billion-dollar pieces of capital equipment, billion-dollar plus, and so if anything, my experience at BP over the Clean Tech 1.0 and the 150 rounds of financing I did there, it always takes longer and it always takes more capital. So I think we're coming into this fund with that frame. We do underwrite in individual cases on a case-by-case basis. So if we, as I say, typically we're a Series C, Series D, but we have made our first Series B investment, and so rather than thinking there's 1 to 2 rounds of financing, we're thinking there's going to be 3 rounds of financing. I'd say our base case for modeling is pro rata participation, but the rationale for reserving a third of the fund overall, so sort of 450 for follow-on, is we want to be able to double down and sort of increase our stakes in select opportunities where it makes sense to do so. I think what else to say, we don't pre-approve follow-on investments at the time of investment. We are our own investment committee to a large extent. So the 4 investment managing directors, one of which myself, Megan Sharp, who's the CIO for the group, and then our head of investor relations, we form the investment committee. And so we can meet very frequently. We're very nimble. We are engaged in portfolio conversations on a weekly basis, so allows us to take those decisions around follow-on in a fairly proactive way. We do have an external IC with BlackRock and Temasek, but that's more advisory in nature rather than investment approval in nature.
Got it. Great. So Sandy, what are you observing in your practice in regards to CVC clients? Has there been an evolution of thinking about follow-ons, planning for them, and any thoughts around kind of the best practices that you've encountered?
Yes. I mean, I think there has been a real evolution I've been seeing corporates in this space since I started practicing, 25 years ago. And it used to be that corporates would be very clear. Look, we don't know what our budget's going to be from year to year. We're making this investment. Don't look to us for later rounds. And I think that was part of the reason why corporates got a little bit of a bad rap. It's not dependable capital for future rounds. But I'm happy to see a very positive evolution over the past, 5, 7, 10 years, where corporates and traditional venture capital are really starting to meet in the middle, meaning that corporates understand the need to be a true partner to the businesses in their portfolio. And part of being a good partner is being there for subsequent rounds. I think traditional venture capital seems to be appreciative of that development and being more open to much more open, actually, to having corporates on the cap table, as well as being, referenceable customers and co-development partners. So
kind of more playing by the rules of the game, as we talked about earlier, and the behavior is getting more and more supported by the VC ecosystem and welcoming that as part of the syndicates, it sounds like.
right.
You're seeing more planning, not just ad hoc follow on. Is that correct?
Yes, I think that's right. I mean, it's really not even a question anymore that, the clients who I work with just have in mind, whether it's, a specific, percentage of their funds available to invest that they reserve for follow-ons, or if it's just a mindset that, even if we're still investing from the balance sheet, it is, especially if we're investing in the earlier stage companies, of course, we're going to be asked to invest in subsequent rounds.
Yeah. Okay, so thank you. As far as your investment committee, David, you kind of explained the dynamics of that kind of being more of the team itself, but Crispin and David, if you want to weigh in, are there any differences in the investment decision-making processes between initial investment and follow-on, as far as criteria or level of approvals, those kind of things?
Maybe I start to jump in and just re-emphasize what Sandy just said, that I think if you have it was just mentioned, the startups that we invest in actually have nothing to do with our corporate. The corporate is our backer as an investor, and we run a CVC operation. So we have a capital commitment, because, I mean, if you want to talk about follow-ons and you have no capital commitment, then it can be very difficult if you start a new process. So therefore, a capital commitment. And in our setup, it even goes one step further because we're an evergreen. So it's not only meant, okay, there's 100 million commitment, but when we exit participations, we distribute the money, and then we can even redraw the money to reinvest it into startups. So that means that we're even have a certain independence, even that we don't need to raise another fund. But if we are successful, we grow out of ourselves. And of course, we can bring this commitment then also to the entrepreneurial teams that we invest in. And I think this is an important message. Now, with regards to the investment committee, I think this is another thing where I would urge every founder and founder team, talk to your CVC and understand what is their setup, because there are many different setups. Our setup is that we actually, the investment team is suggesting the transaction to the investment committee, and then it's jointly decided, and it's just a majority decision, so it's not unanimous. That's quite important. And this investment committee is not filled only with some corporate players, but it's also filled with external specialists. So tier one VC partner and so on. I think these are all sort of important ingredients in order to then do sort of the follow-ons. And the process as such, I think, like I mean, there's of course a difference because you are already on the cap table, you know the team. I think the whole round preparation, if you look on the follow-on, is something that should be done together. If you are in lead anyhow, but if you are a co-investor, you're actively engaged in defining together with the founder team how should this round look like? And then you are, of course, engaged earlier. And there might be many important questions to solve, like, okay, so the existing investors, how much of the round do they want to do? Sometimes they want to do it completely. Sometimes they only want to do 20%, whatever. And then there's, of course, the question also, what is the optimal setup of the consortium? Is there a specific investor type targeted or anything like that? So all these things needs to be discussed. That is different. Well, it's not so different because even in the initial investment, when you have the term sheet and the consortium, these things are also discussed, the different timelines of the investors, does it fit, and so on. But from a due diligence perspective, a follow-on is of course much easier because you know the company. I mean, you are in close touch, you have all the current data. You don't need sort of the deal in order to get all the details. So that should be much easier. And then, of course, you know the team. And I think the last point that I want to mention is there's quite a duty. I mean, if you are on the cap table of a startup, especially if you are a CVC and you bring a brand and a trust, I think you have to also understand that there is a certain responsibility to be early involved and to also actively discuss this. And if you don't want to follow on, to indicate this very early in the process, to communicate this clearly. And it should not focus around your own strategy or so, but just around the success of the startup. So the only reason not to participate, in my view, is that the startup has absolutely not delivered what they promised. There can be no other reason. Great.
And that kind of leads to another question. When is it appropriate? You just stated the only reason in your mind when it's not appropriate to follow on, but any other thoughts about that, David or Sandy? When do you think it's a good excuse not to follow on?
I mean, I'll just take a moment to applaud Crispin and his clarity of view and I'd say maturity of approach and understanding the responsibility that a brand name has on the cap table. You know, it's something we wore very strongly when I was in my previous shop. I'm not going to talk for the team now, but certainly as a financial VC looking at opportunities where strategics are on the cap table, when they're not participating, you have to wonder if that is a budget issue, or is it a technology issue, or is it a management issue? I mean, what are you, obviously this is for new investments, not necessarily for follow-ons. Yeah, I mean, for us as a financial VC, we don't have that way of winning as a strategic, right? We're really here purely to return capital to our LPs and hopefully drive material CO2 changes in terms of the impact of the opportunities we're going to support. So I think the decision we're making is really, are we in? Are we doing pro rata, or are we doing more than pro rata? And the passing on an opportunity will be driven by either lack of performance by the underlying opportunity, or the terms that are being offered by someone writing a term sheet. And I would say in cases where the valuation is being taken up too high, or the terms are more punitive to other investors than they perhaps should be, I think we may choose not to participate. I think we're very conscious of building valuations too high too quickly, round on round, as you're heading towards an exit. We've seen this happen in previous cycles where valuations sort of accelerate way past the underlying performance of the business, and I don't think that's something we particularly ascribe to.
That's interesting. So there's actually a case where the company is performing well, but let's say 2021 multiples have gotten so high that you don't think it's a good return on investment opportunity, and you might pass on a follow on.
So that's a hypothetical. We're not in that situation. If anything,
Right.
We're seeing valuations trend in the opposite direction.
Right.
What I would say is what we might do is limit our participation to a pro rata participation stake. As I say,
Okay.
the stage we're going into, we're going to be 5 to 15% of the cap table. We won't write a check less than sort of 25. So we've got a lot of gas in the tank in order to make sure we can continue to participate going forward. But it would be taken on a case-by-case basis if the valuation seems to have been pushed too far, and I would, excuse me, but if it's also being priced by a strategic and being priced up outside of market, we would feel incredibly nervous about that.
Yeah. So one of the factors sounds like might come in is how would it affect the portfolio company? If they've got more money than they're turning away money, it's not going to hurt them as much if you don't participate. Whereas if they're really doing well but still having problems raising money, then it's even more critical to support. Is that fair characterization of the situation?
Yeah, I think that's fair. I think also we would be very careful in a situation where we're already on the cap table and we are writing terms. I think there's a whole thing around, as an insider, you're setting the price. I think our approach in that situation would be, if let's say the company hasn't managed to hit its marks, isn't hitting its milestones, but it needs capital, and you're facing a challenging fundraising market, better for the insiders to hunker down and put together a bridge note. Don't price it, but put together something sensible, and then try and lean in and shave costs and try and get the company to that inflection point to raise capital again. I think that seems to be the more sensible approach than an insider-led price up in a down market with lack of performance. I think you're just setting yourself up for a little bit of a challenging situation further down the line.
And we're seeing a lot of that going on right now. Sandy, I think you wanted to add something.
Yeah, I mean, so many great insights from David there. I would just say, from the legal perspective, you did touch on an area where things do tend to get complicated because the nature of CVC's involvement with these portfolio companies, right? A lot of times there's not just an equity investment, but there's also a commercial arrangement. Generally speaking, I would say the corporates that I work with are reluctant to be term setters, especially if they're already on the cap table, because they recognize that it's so important to keep all the members of the cap table's interests aligned with the companies and each other. And if you are too permissive on valuation, that throws incentives off for others. And if you're doing that because you see other rewards coming to you from the commercial angle, you've just got to think that through a lot. I mean, there are, there's an alignment of factors where the technology is doing really well. They've got a lot of traction in the marketplace. And for that reason, this is a very valuable commercial relationship. That should be ideally reflected in the valuation that holds for all the investors, financial, strategic, and otherwise. But it is something that we think a lot about, the governance issues from the CVC's perspective, because there are a lot more opportunities for there to be conflicts of interest.
Yeah. Well, one of the problems I see with investment committees is getting them over the hump on a follow-on is the case when the company that they've invested in was mainly for strategic impact, and that strategic link has gone away, or the reason for doing the strategic deal has gone away. Is that a good reason, Sandy, in your mind, to not follow on?
I guess I would say I would always look for a way to align the interests. I think if the strategic reason has gone away, hopefully there were other reasons that the corporate invested in this portfolio company in the first instance. And it may be that they're pivoting strategy. That might, to me, that would indicate maybe you should rethink your commercial arrangement if you have one with the company. Not necessarily that you should not participate in a follow-on, because if the value continues to be there from a financial perspective, I mean, why not? Why wouldn't you participate? And why wouldn't you continue to support the company that probably relied to some extent on you being a referenceable customer, or the brand value of having you on their cap table?
Yeah.
So I think that there's likely an outcome where other value can be found, and hopefully it was there when the investment was originally made.
Yeah. So Crispin, you've got kind of a unique model with the evergreen, and the fact that you don't necessarily require a strategic deal or strong thing. I'm assuming you have a relatively strong opinion on that question. If it's no longer strategic, is that a good reason?
Yes, definitely, Mark. Right guess. No, I think what Sandy just touched on, this conflict of interest that was described here is, I think, one of the root causes why CVC and so many corporates have gone into trouble with CVC. So we are trying to put this actually upside down. So why do we exist as a CVC for our corporate investor? Well, first of all, we run a financially driven professional VC activity, but with an investment strategy that is, of course, geared towards topics that could be one day interesting or even impactful for a corporate. But there's no hard wire, there's not sort of, hey, you have to do now this and that. But instead, we have to prove that we invest into successful startups. And the more successful they are, the more opportunity and readiness is on the corporate side to actually cooperate. I think another very important piece in the puzzle is that I think it is paramount for a modern CVC organization to strictly separate any investment activity from an operational commercial cooperation activity. It has to be a Chinese wall. Otherwise, you run into constant trouble. I mean, your colleague is calling you, hey, can the startup still go down with the price a little bit? And you're saying, oh, well, when we get these calls, and we did get them in the past, then we say, guys, we're sorry. Our interest is the maximum value for the startup. So let's open the doors. You guys have to commercially negotiate. That's your deal. We love if you cooperate. But at the end of the day, we want the startup to be successful. So our interest is the maximum value of the startup. So don't ask us to give you any insights. So there's a strict separation. If you mix up your investment activities and then try to sort of use your muscle to achieve things that are not sort of commercially sensible for the startup, that is against the other shareholders too. So you lose with the team, you lose with the co-investors. I think it's amazing that this setup is happening again and again, but I think it doesn't work. It just does not work.
Yeah,
that's a surefire way for you to not get good deal flow going forward. If that gets
If
into the
people-
market, that's it, you're dead. Yeah.
Exactly, but I also hear still oftentimes that the CVC is a sort of part of the M&A team or part of the strategy team, or I don't know what. I mean, that does not work. These things are completely different. Like if there is an exit and our corporate wants to buy the startup, well, then this is at arm's length. The M&A team is going to the entrepreneurial team and they get the data and write an NDA from the startup. If the startup team tells us, can you support, can you help? Then we're ready to do so, but we would never sort of give them any sort of insights that could be in any way harmful to the startup. So, and this is really the 101. I mean, you have to do that. If you miss on this one, you will not succeed with the investments. You will not succeed with the impact on the corporate, because from this win-win that you could build, you end up with a lose-lose.
You know, it's clear that to build a sustainable program, you're going to need to do that. We have two questions come in from the audience along these lines. Is there a way that, Sandy, you've seen, and David and Crispin, a good way to handle that discussion with the investment committee or your single LP about educating them to the need to do that?
I think that's really the key, is educating and having these are nuanced, complicated discussions that you need to have with all the stakeholders within the corporate. And it takes time, and you've got to win the hearts and minds of the C-suite, maybe your board, and your key business leaders. While people tend to come to corporate venture capital units from lots of different backgrounds. Maybe they were, head of corp dev somewhere else. Maybe they come from the venture community. Maybe they come from an operating line in the business. But they've all got to have alignment of goals and values that are going to be implemented in the deals that you do. And as David said earlier, your first few deals are super important. If you signal to the market that you are a non-commercial, hard to work with, you're only in it for yourself kind of partner, you're not going to get the good deal flow. You're not going to get invited to the competitive, most compelling deals. And I think what I tend to see across the clients who I work with are the ones who come to the corporate venture capital unit from a big ticket M&A PE background, where you're taking either the whole company or a controlling stake in the company, where you don't have to listen to other voices. That is the hardest group to get them to change their mindset and to be really effective here. So I would say that is what I spend the most time advising new CVC units to do, to really sit down and understand what ecosystem you are stepping into, and to everybody needs to be on board with the behaviors that are going to be accepted, that this unit is going to demonstrate as they make their first investments and through the life of the fund.
I'd agree with a lot of what Sandy said. I mean, wanting to be totally respectful to Gareth and team at BP, because I don't know what's going on there anymore, but we worked really hard to try and move the follow-on decision away from an investment committee conversation. And we managed to get approval that if we could continue to underwrite the returns that we expected from the original case, we could continue to deploy dollars after dollars from a financial lens. And I want to say that, I kind of looked after the commercial team. The same, most follow-ons and term sheets came through me. I'm a finance guy by background, but I think reorganizing or rethinking your role as a corporate VC, you don't just want to be a cost center with the idea that strategic value is happening, but it's happening in a different part of the business. If you want to be good as a VC, make money, make returns, which means underwriting to financial basis negotiate hard on the terms, make sure you understand the business model, and actually allow your money to follow your money. If strategic happens, great. Do you know what? If the strategic rationale goes away, you're still going to make a return for your corporate, which is still returned to your shareholders. It doesn't all have to be this kind of, excuse me, slightly wishy-washy strategic value piece. It's really hard to quantify. I mean, we worked with Liz and Heidi at the Bell Mason Group to come up with a format for us back in the day. And, you know, it's quite a broad spectrum. I'm sure this next wave webinar series has got something on how to do strategic value, because there's many different flavors of how to do it. I'd say, look, be a good VC. Just because you're a corporate, be a good VC. Invest dollars, try and make money on the return. And if you get strategic value from some sort of collaboration, that's awesome, but that's upside.
Great.
Yep, we're actually 100% there. Sorry to jump in here, but we're 100% there. First thing is financial return. You need to prove that you're able to realize your business model successfully. And I mean, I think, and this is why you can just put a couple of very simple questions together in order to figure out if the CVC is a professional investor. Like, is there a separate legal setup? If it's not, because what you just said about the investment committee, our investment committee is a completely different route. It is our investment committee, EnBW New Ventures. It has nothing to do with the corporate. So the task of the investment committee is for each deal to discuss if this is a good deal, the valuation is right, if the startup's developing well, if it fits to the portfolio, what the exit is, and so on. It has nothing to do with any strategic side discussion or I don't know what. So I think this is pretty important, that the corporate understands if he tries to micromanage the VC unit or the CVC unit, this ain't work. So you really need to build. But on the other hand, you have to, of course, acknowledge that a corporate has a governance. So a C-level cannot just hand this over and say, okay, here's the 100 million, do what you want. So you need to set up a structure which is highly transparent on sort of how your deal making is going, how is the growth of the overall portfolio, not an individual startup, but the overall portfolio, how good your exits are, what's your NAV, how is it quarterly developing, and so on. So you need to have all this data. You need to have the KPIs. Where's your TVPI? Where's your DPI? You have to have these things constantly. Otherwise, and in order to train and teach that they understand the business model. And I think my biggest advice would be on day one, before you actually start, talk to all the C-level members, all the board members, talk to them, try to understand what do they expect from the CVC thing. And of course, they will want to have impact on the corporate. And then try to explain what David just said. It's CVC, so VC is in this word. The business venture capital. So you're getting capital and you have to cross the hurdle rate and you have to be above this hurdle rate and you have to be incentivized on this. These are sort of ingredients. You have to have a capital commitment. If you don't have a capital commitment, I mean, how can the startup take the risk that if that you then come back and say, yeah, I want, but unfortunately I can't, because the controlling is saying ABC. So I think this is just, all this is a question of the original setup of the unit and the understanding on the C-level suite, basically how this works.
Yeah, and I think my takeaway here is if you're not transitioned to a more independent structure and governance like what Crispin has and certainly what a venture capital has on investment committee decision making, you need to do a great job of education and continued education, and try to get at least to a pre-approval of reserves and follow-on capital that's already understood that that's going to be there for you. If you can't do that, then make sure the criteria is very easy hurdle to get through, and not restrict you to having to go back and fight for a follow-on when it makes sense. Let's get on to a couple of other questions that have come up in the Q&A. What are some other risks besides reputation, which is critical, brand, credibility, and the ability to get pulled into syndicates, which all will be jeopardized if you don't follow on? What are some other specific risks of not following on? Sandy, do you want to talk about that as it relates to rights or anything related to the deal with the company?
Sure. I mean, aside from the reputational issues, which we've already discussed, I think, not following on this, I think that there's just some tactical different things that you might start to lose visibility into what the company is up to. Maybe you lose your observer seat because it, by not participating, it might signal that you're kind of leaning out from the company, and you no longer merit a seat in the boardroom. Maybe your information rights start to get constrained, and maybe you're just less a part of the conversation. And maybe that's okay. Most of our corporate clients have a certain level of information rights that they need to have in order to, mark their investment to market and comply with their own internal reporting obligations. But I would say that those are probably the things that you start to lose.
Great.
I mean, I'd just add that even this CVC ecosystem is a small ecosystem.
Right.
Broadening out to the VC ecosystem, it's a small ecosystem. If you it's just seen as a fair weather investor and can only support companies when you're doing better than other folk around the table, it's just not a way to play. This is a team sport, and it's a long game to get these companies to the point of them actually being successful. And if you're not going to pull your weight, you're just not going to be invited to play anymore. I mean, it's as much as that, right? Now, if the startup's strategy changes and it's no longer important to you, okay, maybe there's a conversation there. But if you focus on making returns, I admit they may be immaterial for your corporate balance sheet, those returns. But being a profit center is better than a cost center, regardless of the quantum of dollars you're talking about. And you will absolutely lose all of your rights if you don't participate eventually.
Yeah. Information board, whatever it is.
Maybe one last from my side, just into follow-on round. I think the magic of the follow-on round actually is happening in the initial round. So if you have set up the consortium in the way that these investors talk to each other, know the team, know their time horizons, know what they want to achieve with this investment, I think if you have a huge issue with the next round and so on, probably you have already in the initial round seeded this issue. And if you're doing the things in the right way, I think then there's a fair chance that if there's not a fundamental issue in the development, like someone has you completely outcompeted or your technology doesn't work or I don't know what, that then the follow-on round should happen and should be possible. Okay,
we're just going to have one more quick question, and then we're going to wrap things up because we're coming up on top of the hour. What are other mechanisms for supporting the portfolio companies? Not saying you won't follow on, but in addition to following on, how can portfolio companies maybe earn equity without having to maybe just meet their pro rata, but still have some leverage in getting a higher return? Sandy, do you want to comment on that?
Sure. And I see in the question that there's a mention of performance warrants, which is my personal favorite instrument to talk about. We could spend a whole hour on that. I could anyway. I think that there are ways to earn equity. I mean, we do it frequently for our clients where we set up the right to earn additional shares. Typically, these are penny exercise price warrants in return for in-kind contributions. So development support, sales support, PR support, because typically these CVCs tend to have very valuable brand equity, and a previously unknown early stage company in particular can benefit tremendously from the endorsement that they receive from a large corporate with, that's a heavy hitter in whatever the industry is. So we use performance warrants frequently, and that is a way to get additional equity into the hands of a corporate without skewing valuation or the traditional financial investor metrics too much in a corporate's favor.
Good, thank you.
I'd maybe just nuance that it's absolutely on top of equity, and they can't. It's not a substitute for. And I think as a corporate, you need to have a credible view of the actual dollar value that is ascribed to those activities.
Right.
because the corporate cost is typically much higher than the cost it would be to the startup in any case. So I think it's just making sure that it's fair transfer of value.
Right,
Yeah.
right, exactly.
Yeah. And then reasons for, we talked about some reasons for not following on. Some corporates look at lack of strategic, that's questionable. But David, what's a scenario in which you would find it acceptable for a CVC not to follow on? Or is there one?
They're closing doors.
Okay. Okay.
I mean, okay, let's say you've invested in a startup that says it's going to produce sustainable aviation fuel, and you're an airline, and the technology pivots and it's now producing diesel. Okay, fine.
Okay.
Maybe that's no longer a fit. So I think if the startup business changes materially such that it is not the thesis you invested under, then maybe there's a conversation to be had. But again, I'd say RD can be incredibly valuable. So if you lead with financial, you can, and there's no reason why RD can't pivot back to SAF if the tailwinds are there. As again, these are long-term horizon investments. You need to take a long view of the value that's going to be ascribed to them. And if you invest on a financial basis, even if you're putting in additional dollars, you should be getting a return.
Got it. And so my takeaway there, if I can paraphrase all the feedback, is it might be okay not to follow on if the portfolio company changes strategy, but not necessarily if the corporate changes strategy. And then 2, if the company is clearly not meeting milestones and your syndicate is not supportive. And 3, maybe not following on as much if the deal has kind of gotten away from market reality on valuation and terms. Okay, let's move on to wrapping up the panel. And I just had a few comments here at the end to wrap it up. But I want to thank David, Sandy, and Crispin very much for their help. And wanted to let you know that the next wave webinar series will continue on June 12th. This one will be focused on sports tech investing. And with the Olympics coming up, we think it's a timely topic. And then we've got some upcoming institute courses. Some of our investment programs, you got a taste with what is covered in some of the courses on the investment programs. We have both live online and in-person versions coming up shortly. And you can visit the Institute website for the full year calendar. The Landing the Value of Corporate Venturing program is a pod-based deep dive course focused on developing end-to-end investing strategies and building professional corporate venture business development and portfolio development platforms and programs for the parent and ecosystem engagement coming up later this year. And if you're looking to meet up with the CVC community and take advantage of our compelling programming, you can join us at upcoming events coming up around the world. GCV and Symposium, fast approaching in June. That's in London and serves as a CVC watering hole in Europe. The Executive Leadership Forum in California will bring together CVC leaders. Corporate Venture in Brazil is kicking off a series of Q4 global events, which will also include Asia and Germany. And also stay tuned for Connect networking events in your regions, and those will be announced. Replays of the webinar and all others have been conducted are available on the GCV website, as are the summary articles produced by GCV's great editorial team. Feel free to reach out to me or my colleague Liz Arrington for more information about Institute courses or Keystone CVC benchmarking data. Make sure to visit the website and for news, analysis, community, and reports, and check out our podcast series called CVC Unplugged as well. So I want to thank the panelists again for sharing their wisdom and insights, as well as you participants for showing up and also contributing some good questions, which really made for a rich discussion. Okay, well, take care. Have a good rest of the week, and thank you for attending.